on the latest with US-China trade talks. We begin this hour with this week's rally on hold as China downplays progress in trade negotiations. Jason Thomas of Carlyle writing, if Treasury yields do not decline when stocks sell off, investors may discover they've been paying for a hedge that no longer works. Jason joins us now for more. Jason, good morning. Good to see you.
Good to see you. Thanks for having me.
I'm pleased you've picked up on that piece because I want to pick up on it with you as well. This EM-type dynamic that started to take hold of US assets, dollar-denominated assets, what's behind it, one, and do you think it's sustainable, two?
Well, I think, first of all, we have to remember that bonds are volatile in a way that cash is not. So at the start of this month, if you had $100 invested in money markets, it was yielding 4.3%. The 10-year Treasury at the time, 4%. A week later, the cash was still at par, as it always is. The bond was down to 96. And so in the past, there's generally been, of course, a term premium to compensate for the volatility. That went away in the decade after the GFC. Why? Because anytime there was a hint of weakness in the economy, anytime there was a decline in stocks, the Fed would launch another round of QE. With, of course, the intention of driving down bond yields. So, of course, there were many risk parity strategies. You had investors who were hedging their stock market risk through leveraged positions in bonds. That worked very well. Some years, stocks down 12%, those leveraged bond positions up 15%. Now, I think we're in a somewhat different world. Partly, of course, that's the external sector wondering about being over allocated to the US. That's stocks, that's bonds, I think more broadly. The deficit, when you think about how large the deficit is, this year, Treasury net issuance is consuming over 42% of US private savings. That is the savings of the household sector, the free cash flow of the corporate sector. So, if this is not going to be financed in large part by external investors, you have to wonder what the market clearing interest rate is going to be. So I think that what we're seeing is that if there is not this hedge, if treasuries do not predictably rise when stocks fall, then there has to be a much larger risk premium on bonds relative to cash. And if you look historically, the 1980s, 1990s, that was in the range of about 150 basis points.
So it feels like that process is underway. We're working our way through it. Without doubt, you can see it on the screen in the price action of the last several weeks. I want to understand from your perspective how investors should now manage that risk. They've got very used to having this ballast in the portfolio that treasuries typically provide. Where do you go now?
Well, of course, I would recommend that people go to private assets, particularly private credit. But I think that the general portfolio thoughts have to be re-examined. There's talks of a 50, 30, 20 portfolio. But in general, it's that what has worked, what worked so well in that decade after the GFC is not going to work today. So whatever your solution is, there needs to be a rethink. And I think that, again, it's been so ingrained that treasuries are supposed to rise in value when stocks fall. There's no mathematical law that's supposed to occur. And again, the return correlation with stocks and bonds was positive in the 1980s and 1990s. So this is not entirely new.
Yeah, there is a larger consequence here, though. I'm thinking through as you're saying this, and if you're talking about a clearing price that's different for treasuries to account for that additional risk premium, we could be talking about 5.5% on 10-year treasuries pretty easily based on your calculations, which would have a massive effect on private asset valuations, which would have a massive effect on stock valuations, which just kind of really speaks to this question of whether it's a sell America trade.
Well, I think that, again, if I were thinking about exposure today, it would be short duration. I see a lot of duration risk in the market. And I think generally investors have not had to worry about duration risk. It's again, the mindset is whenever we get into trouble, there's going to be another round of QE and they're going to drive down longer term yields. Now we're in a situation where those prices could move in the opposite direction. And that actually compounds losses. I think that the issue right now also, the Treasury is funding 22% of the outstanding stock of debt in the bill market, in the money market. There's of course a desire to term that out, but there's of course a hesitancy. We want to wait for the right time. I think people were hoping that the 10-year would fall below 4%, and let's term out some of that debt. And by waiting, they might be in a situation where they have to term it out at much higher yields. So it's certainly a concern. And I think, as was mentioned earlier, if you do have a downturn, if you have a decline in tax receipts, if you have an increase in transfer payments, just the scale of debt issuance, and now it go from 40% to 50 or 60% of private savings being consumed. So again, I think it's taking the short-term assets. Sometimes the credit spread on that is less risky than the duration spread of holding longer dated assets.
Has this dynamic removed a lot of the power from the Federal Reserve to really address downturns? And I say this at a time where potentially if they drop rates right now, that will only lead to a furthering of this trend of yields in the long end going up.
It's a great point, but we have to remember the Fed is an extremely dovish institution. I mean, and of course they say that's because of the dual mandate. But I mean, think about 1998. The U.S. economy in real terms growing at 4%. Employment to population ratios at all-time highs. The enthusiasm of the stock market. This is 2 years removed from Alan Greenspan's irrational exuberance speech. And they cut rates by 75 basis points because the hedge fund failed. When you think about 2020, the way they did the autopsy of the last 10 years and the statement for policy goals going forward, they said the big mistake in the decade of record monetary accommodation was hiking too fast in 2015. So the Fed is going to cut this year. I mean, it's funny that this is like controversial or, oh, the Fed's in a box. The Fed is going to cut and likely by September.
But how much has the pandemic actually hit them hard in terms of wanting to make that mistake again? Governor Waller said that to Mike McKee, that idea of being transient. He's even nervous to say that word out loud.
I think that this is what Chair Powell has made clear is they can't do preemptive cuts. They have to wait. They have to see.
Didn't they preemptively cut before the election?
Well, I think there was certainly a strong case for rate cuts in September. Now, whether they needed to cut by 100 basis points in just over 3 months, again, this is sort of the dovish nature of the institution coming to the fore. But I think that this is a situation where if you are cutting as tariffs are first taking effect in terms of the increase in the price level, you could accommodate a spiral. So they have to wait. But we're talking about waiting a couple of months. This isn't really, an elongated pause or anything of that sort.
You've said a lot of things that require some real deep thought. There's one thing that scares me. Typically in an economic downturn, bonds rally, and that allows a government to act countercyclically. A developed market government, EM, of course, face a very different dynamic. Are you saying that if we go into a downturn, the long end doesn't rally?
I think that the rally is going to be muted. And so, again, if we think, I think the Fed will be more cautious this time, of course. But imagine that we have base rates in the 365 range. Well, these yields actually might be appropriate given the risk premium, the term premium that is required. Maybe you get down to something closer to 4%. But again, I think the important thing as investors think about the next 5 years is that if bonds do not rally in this scenario, that on a prospective basis, when the economy recovers, that they're going to need to target much higher yields, that compensation for the bond price volatility that doesn't exist in cash.
Jason, this is an important exercise. I'm pleased you dropped by this morning.
Thanks so much for having me.
Thanks for being here.